Good morning, everybody. Welcome to this Harvard Kennedy School conversation. Is this time different? COVID-19 and the global economy. My name is Nick Burns. I'm a professor at the Kennedy School. We've been very much looking forward to this conversation between Dr. Carmen Reinhart, the Vice President and Chief Economist of the World Bank, and my colleague and friend, Professor Larry Summers of Harvard University. Let me say a word about the sponsoring organization of today's talk. It's the Economic Diplomacy Initiative at the Harvard Kennedy School in the Belfer Center. This is the creation of a supremely gifted, creative, and smart executive director of the Belfer Center, Aditi Kumar. Her vision, shared very strongly by Larry and I as her faculty co-chairs, is that economic power is a key dimension of statecraft, that the United States and other countries need to think about how to deploy that economic power. And at times it might be even more important than more traditional aspects of power, such as military and political power. Under Aditi's leadership and that of a very large group of students and younger alumni at the school, we're focusing on some big issues. How can economic power help to achieve our most important foreign policy strategic objectives? How should we think of trade, the advent of digital currencies and sanctions, as major aspects of a country's power and influence? In the last year, we've hosted Christine Lagarde when she was still at the International Monetary Fund, Penny Pritzker, Mike Froman, and the former governor of the UK Central Bank, the Bank of England, Mark Carney. Today, it's a real pleasure to welcome back to the Kennedy School Dr. Carmen Reinhart. She's on public service leave from the Kennedy School in this very important position of Vice President and Chief Economist of the World Bank. Ironically, Larry Summers, who all of you know was US Treasury Secretary, Chief Economic Advisor to President Obama, was also at one point earlier in his career, Chief Economist of the World Bank. Carmen and Larry, here's what's on my mind as we think about this big subject today. Why have the world powers been so ineffective in fashioning a united global response to COVID-19 and the global recession, at least in contrast to what happened in 2008 and 2009, and Larry was part of this at the advent of the Obama administration, when the G20 swung into action, concerted international engagement, at least at the head of government level. The G20 has been nearly invisible. Why have the US and China chosen to compete rather than cooperate on the coronavirus? Look at their fight over the World Health Organization. What are the consequences for global poverty and the global South if there isn't sufficient international cooperation? And what are the consequences for global stability, if particularly the US and China fail to see a common interest in fashioning some type of international cooperative effort? Those are some of my questions. But I want to turn this over to Larry, who's the co-chair of this Economic Diplomacy Initiative. For those of you watching today, we've got a big group of people, over 250 online with us. After Larry and Carmen have their conversation, Aditi is going to chair the Q&A portion of this, and just go into the Q&A function on your Zoom. Ask your question. We'll get as many questions in as possible. Carmen, welcome, and Larry, thanks. Over to you.
Thank you very much. Thank you, Aditi, for the great job that you and your colleagues have done with respect to this economic initiative. It's always a pleasure to be in dialogue with my colleague, Carmen Reinhart, from whom I've learned a great deal. Carmen, you've got an incredible reputation and a well-deserved reputation as a scholar of financial crises, and more specifically, a scholar of experiences with big accumulations of debt. And we're certainly seeing some big accumulations of debt right now. If you had to, in a broad way, talk about what the commonalities are between the current big buildups of debt and debt crisis risks and the global historical experience with debt crises, and the differences between now and the past, how would you characterize the main common elements, and how would you characterize the main distinctive elements?
So, with common elements in terms of the buildup that we're seeing, you really do have to compare it to wartime. And the speed and scale is seldom seen, especially at the global level, meaning, it's not a couple of countries, a handful of countries, but pretty much across the board. That scale usually is more typical of comparable to what you see during a war. The major difference with any financial crisis that I've seen, of course, is that, there's a certain trajectory. I don't want to really overstate the word predictable, right? I don't want to overstate that, but there's a certain trajectory that your financial crises follow, which, preceded by some economic excesses, the, bursting of a bubble, period of, recession and so on. But we really are held hostage to the path of the disease in this. So that's very, very different. And the path of the disease is very uneven. I mean, the lockdowns, the economic implosion, if you will, has been fairly synchronous across the globe, but yet the actual path, trajectory of the disease is very uneven. I am speaking from Florida to you, Larry, so we're at the height of it, practically at the height of it at the moment. And the expectation, for instance, is, as you know, the World Bank has a lot of involvement in Africa, and it's not supposed to hit there in full peak till January of next year. So this plus, and this is the first wave. So this plus the possibility of a second wave or whatever introduces a great deal of uncertainty on how long this will last. So how long the debt buildup will last, and therefore the longer it lasts, the more things become frayed at the seam in terms of a debt buildup becoming a debt crisis. And we are seeing already a number, especially among the poorer countries, including, well, some of the middle income countries came into this, like Argentina or Ecuador, Lebanon. These countries already had a full-fledged debt crisis prior to this. But the key point I'm making is the longer it lasts, the more havoc that is created in the economy, the more likelihood that we will see more debt problems surfacing, and you see them most acutely in countries where the fiscal space is most limited. And there you have to start with some of the poorest countries and work your way up.
Since you talked about the poorest countries, since the World Bank has probably a comparative advantage in its importance in the poorest countries, let me start there and let me put to you what's kind of an academic view of this. It's not necessarily mine, but I think it probably isn't my view exactly, but I think it's important for people listening to think about it. There all this talk about debt and lending and debt relief and all that with the poorest countries is basically kind of a big shell game. That it's like me and my young kids. I care about my young kids. I'm always giving them money. I can announce that I'm lending them money and they're paying me back. but the principal resource they use to pay me back is the money I'm going to give them in the future. And the only thing that really matters is what the transfer of money I make each year from me to young kids is, and maybe how I use that transfer to encourage them to get jobs and the like. But fundamentally, there isn't any kind of symmetric economic relationship. And for the foreseeable future, one side's going to be donating and the other side's going to be receiving. And so debt relief is just another name for, you can discuss whether you want to relieve debt and you can discuss whether you want to increase the net transfer, but it's kind of the same conversation, or it's a conversation about the arrangement of the furniture on a ship that's sailing towards trouble. Is that the right way to think about it? Or is the right way to think about it the way it's more traditionally framed, which is, oh my God, this country has this debt and the debt's in a high ratio to its income, so it won't be able to pay the debt back?
So without dodging the question, it depends importantly in the country. If it's a country that's extremely poor, in which most of the story is grants, then things like, talking about debt restructuring and so on, perhaps, are very different, have, lower degree of importance. They're the poorest countries. Depends who your creditors are. The poorest countries typically have had official creditors, and private creditors have played a much more limited role. Now, the idea that it's all this one-way transfer, Larry, I think it's oversimplified. Over the last decade, we've seen a lot of pretty low-income countries too, so-called frontier economies, issuing bonds that yield very rich coupons. 7%, 8% coupons are not unusual in an environment in which interest rates have been historically low. So there are indeed, transfers south to north as well. A big issue, a big complicating factor, perhaps, in this process where debts may have to be restructured, is that the private sector is playing a bigger role in a lot of countries where involvement was more limited, even as little as 10 years ago. This is in part due to the chronic search for yield, if you will. The second is we have a new official creditor in town that's bigger than the G19, and that's China. And the rules of the game there are also very different. The lending is done in commercial terms. And so far, there's been very little to no evidence that restructuring means debt write-offs. It actually means extending maturities. And I speak from having looked at a large number of restructurings in the past decade in which the MO is debt. So the idea that we can just say, okay, here's a north-south transfer, and that's sort of the end of the story. In a nutshell, it does certainly apply to the very, very poorest, but once you get beyond that, there's a lot of intercreditor issues, in which those making the transfers are not the same players.
Why should the World Bank give any money at all at a 2% interest rate to a country that's paying Deutsche Bank or JP Morgan back interest at 8%? Isn't that just kind of bailing out the banks or paying back the Chinese Export-Import Bank at an interest rate of 4 or 5%? Why should I understand why I as an American taxpayer have a very strong interest in what happens in stopping the spread of disease in Africa, both in a humanitarian sense, in a supporting U.S. allies, forward defense of U.S. security case. I understand a very strong case for foreign aid, but why should we be giving any grant foreign aid to people who are turning around and paying people money to banks that borrowed at 2 and lent at 8?
So Larry, again, I think the answer to that is, well, first of all, a big contentious issue in the debt suspension initiative of the G20, i.e., the G20, as you know, suspended temporarily through the course of this year debt repayments. And this is strictly unofficial, but a big source of continuing frustration. It had been hoped that it would be joined full force by the G20, meaning including China, and that the private sector would follow suit. The private sector has not followed suit, so it does give rise to the issue that, okay, the idea of the debt suspension was that these resources that were temporarily freed up from debt servicing would be used to fight COVID, not to pay somebody else. And there is a great sense of frustration with the fact that there is a big initiative on debt transparency. And this is where it comes in. And this is basically to sort out, Larry, whether indeed those that are supposed to be giving debt relief are giving debt relief. Meaning whether, for example, the participation is full or partial, or so that indeed the governments are still channeling funds that should have been used for COVID relief into debt servicing. Now, you ask why the bank would lend to a country that's also channeling some of the resources into debt repayment. And I ask myself, why would a country do that? Well, life is lived over many periods. And a lot of when you hear these countries say, why are you still repaying? Or why are you not participating more actively in the debt suspension? They tell you, well, look, if I participate in debt suspension, I am concerned about my credit rating, whether, it will trigger cross default clauses. I could be downgraded. We hear that. We also hear concerns about losing future capacity or future borrowing capacity. In other words, the private sector may be more willing to lend to you in the future. The Chinese government may be more willing to lend to you in the future. So there is that intertemporal dimension.
I guess to just put the questions to you, I think the people on the other side of the argument would say two things, Carmen. First, they would probably say, well, okay, if you want to make that decision, you can. But I, as a U.S. taxpayer, am happy to support victims of COVID in your country. But if you want to invest in your credibility with JP Morgan Bank, that's your privilege, but not with my money. And that would be one aspect. And the other is, do you believe this stuff? Argentina had 9 defaults. Macri arrived, and all of a sudden they were borrowing money more or less instantly. I think that maybe if you don't have a lot of debt, people think it's creditworthy. People think you're creditworthy. And if you do have a lot of debt, people think whatever your ability to pay is going to go mostly to the old debtors. So is it clear? I mean, there are all kinds of people, there are all kinds of lenders in the United States who hover around getting the bankruptcy records. And if somebody discharges all their debt in bankruptcy, then they're in a big hurry to make them a carload. And something of the same kind happens globally. And then there's the question of whether banks really are going to be lending money into Africa in the next 12 months. If you're right that the peak of the current wave, let alone the whole thing, is not going to come for another 6 months. Do you think paying back banks in order to invest in your future credibility? I mean, your World Bank went to the United States for a capital increase. Do you think that it's a great investment to give money to the World Bank so it can lend money in this environment to countries so they can invest in improving their credit ratings?
So, look, Larry, if it were that alone, the answer obviously would be no, but it's not that alone. And very importantly, I think the World Bank, like the IMF, like other multilaterals, is a counter-cyclical lender. When things get bad, they step in. That is usually the opposite of what we observe in capital markets. And March, April, early May of this year was a wonderful illustration. The stampede of private capital out of emerging and developing countries in 6 weeks outpaced what it took a full year in the 2008-2009 crisis, in 6 weeks. And that's when the IMF and the World Bank and the multilaterals in general step in. I actually have a paper on this looking at about a couple of 100 years on official lending and what the patterns of official lending are. And one of the, can one honestly say that the official lenders are not gained by the private sector? The answer is no. But can one say that in times when risk sharing is needed?
There were too many negatives in that sentence. I didn't understand. Are you saying that the official lenders are gamed by the private sector?
I am saying there is. There's no denying that that's there. But the question is, if your objective is to help when the private sector is stepping out, obviously the best solution is one in which you can help countercyclically and not be gamed. But usually helping countercyclically goes, the gaming goes with the territory. You do have a free rider problem, and that I wish I could tell you that there's a nice way in financial architecture to avoid that, but when the official sector steps in, some of the bailout will be for the governments that are receiving it, but some of the bailout have been for the creditors. And Greece, for example, Greek, investors in Greece did take a haircut, but a good bit of those investments were indeed bailed out by the official sector. It is in that regard, one of the important, important frustrations, if you will, that you want to help in the bad times. In effect, that in the case of the IMF, that's what they were designed for. In the case of the World Bank, you're supposed to do development lending in terms that are more favorable than the private sector. But it has this unfortunate side effect.
Let me switch gears for a minute, and in just a few minutes, we're going to turn to the audience for their questions. What are you've been in the job now for about a month. You obviously knew the World Bank well before you took the job, but what has struck you so far in your month on the job, and what are your priorities for the next several years as the chief economist of the World Bank?
Well, I think what has struck me, and what has struck me is the amount of work that is being done in the very bizarre circumstances that we find ourselves in. I mean, so the amount of work is just really staggering. You know, the amount of lending, country reviews, the engagement in all the activities. If you look at almost any metric in terms of number of countries, amount of lending and so on, you know, records are being set in an environment in which people are working as we are here, where, you know, everything is, that is, it's pretty striking. It's pretty impressive. In terms of my own agenda, apart from obviously, Larry, as you pointed out, you know, my interest in all the emerging debt issues that I think are going to be coming up. I am also very concerned about the financial sector. And this is not just developing countries. I'm talking advanced economies. I'm talking middle income countries. I think, you know, right now we're focused, of course, on the trajectory of the disease and the, you know, implosions in economic activity that we're seeing. But how often can one point to in history economic contractions of this order of magnitude, a paralysis in such large tracts of or sectors of the economy, and not have financial problems? You know, I think the issues of, you know, non-performing loans, the issues of bankruptcies. We're seeing record levels of downgrades of both corporates and sovereigns. I think the financial fallout is going to be global, and obviously in varying degrees, but it is both global and it is at the moment still somewhere in the back burner. But I think that is something that I'm concerned about. And, you know, this is not a 1 month concern or a 2 month concern. I think this would occupy quite a bit of my focus in the next couple of years.
My last question, if you could write the next, this is maybe harking back to one of the things that Nick Burns asked about in his generous introduction of you and me. If you could write the next G20 communique, what would it say?
Larry, I think, you know, as Nick correctly pointed out, the cycle of globalization and, you know, globalization meaning encompassing, you know, the big government's view also on cooperation and coordination. And it went from, I would say, a peak just before the global financial crisis, and it's only gone in one direction since then. You know, in a very short piece that I did for Foreign Policy, I said, look, you know, I think the COVID-19 crisis has put, you know, the nail on the last nail on the coffin of globalization. I mean, we had the crisis, which meant that, you know, the 2008-2009 crisis, which, you know, put a brake on, especially in Europe, on integration. You know, the North-South divide began to emerge. Then we had Brexit. Then we had the Trump-China war. And then that is how, in that environment, we entered COVID. So the answer for a global problem is a more global solution, meaning, you know, more orchestrated. If there's going to be help for, say, the lowest income countries, you know, more orchestrated efforts along the lines of the DSSI, but, you know, on a grander scale, there is no, from the advanced economy side, there is no Marshall Plan. You know, there is, I would say on the central bank side, you know, there is indeed quite a bit of collaboration, but the very real threat of, you know, continued trade wars and amidst global supply shocks that tend to be fragmenting, you know, is I've raised the possibility is, gee, didn't we learn something from the 1930s that in the midst of adverse shocks, you start adding, you know, inward-looking policies, and it's if you're starting out from a bad situation, it's bound to make it worse. So I'm not especially optimistic that, you know, in light of that trajectory, we're going to see a big reversal soon. But the obvious, to me, answer is this is, you know, given the global nature of this, given the seriousness, both in depth and persistence of the global shock, you know, I used loosely, perhaps too loosely, the term Marshall Plan, but a plan that how we're, you know, how we're going to coordinate to get ourselves out of this and get others, you know, out of it is needed, but not likely to be forthcoming.
Thank you very much. Aditi, I can keep this going, but I think it's the time when my instructions, and you give very firm instructions in your very nice manner, are that I'm to turn this over to you to represent the audience. So Carmen, thank you for the chance to engage in this conversation with you. I've learned things from the way you approached arguments that you and I have been engaged with for a long time, and speaking as a citizen of the world, if I could be so presumptuous, I think we're all glad that the World Bank has a chief economist like you at a particularly vexing and challenging moment like this one. Aditi.
Thanks, Larry, and thank you, Nick, as well, for your thoughtful questions. And thank you, Dr. Reinhardt, for being here. My firm instructions to Larry were that we needed to make time for our very engaged audience here because they have a lot of questions for you too. And just a reminder, if you're listening, if you could put your questions in the Q&A dialogue box, I will pull them out and call them to Dr. Reinhardt's attention. So Dr. Reinhardt, let me start with where you left off. You were talking about the DSSI, the Debt Suspension Initiative. You know, looking at the G20 talks earlier this week, you know, what is your view on the outcome of that, of the $5 billion that was suspended versus the nearly $9 billion that the World Bank has said that the poorest countries applied for? And in your view, did China do enough in those talks?
So would you like me to respond to each question? Or?
Yeah,
okay. All right. Very
great.
good.
Thank you.
Okay. So I alluded to this issue when I was talking to Larry, that one of the frustrations of the DSSI is that the whole thought process is free as much funds as you can from debt servicing in this time of crisis so they can be redirected to better uses during crisis time. And the magnitude, the 5 versus 9, roughly speaking, rounding numbers, is part of that frustration. You know, that on the official side, it's important to note, official meaning government, okay, government to government. On the official side, the shortfalls are mostly China. China has been, over the course of the 20 years I, have a study with this, with Sebastian Horn and Christoph Trebisch, documenting that it became the largest bilateral creditor. In effect, China's lending is bigger than the Paris Club combined. So when you look at the 5 versus 9, a lot of that shortfall is specifically that China's development bank, the China Development Bank, according to Chinese policymakers, is not considered an official creditor, even though it is a government bank. And so they have not participated in the SSI, so that the amount of debts that have come under the umbrella of the standstill are smaller than had they participated. So China's full participation in this is critical because they're the biggest creditor by far. Secondly, and I alluded to this in talking with Larry, a great disappointment has been lack of private sector participation. Initially in early May, the IIF, the consortium, private creditors sent some very encouraging signals of their, readiness to go into this with, an open mind. But here we are in late July, and private participation has not really happened. So those are two real sources of frustration in going forward. And I think it is an initiative that the World Bank will continue to try to push forward to get the best kind of participation on both the official side and on the private side. But, it is easier said than done.
Thank you. There's a related question from an audience member on China and the Belt and Road Initiative. And specifically, what do you expect to happen, or what strategic changes and adjustments do you expect to see in China's Belt and Road Initiative in the post-COVID-19 world? Would you expect BRI to converge or diverge further with the World Bank?
So it's a tough one to answer. It's a tough one to answer because I think the COVID crisis is leading to a number of forks in the road that are hard to predict. But let me lay out some of my thoughts on this, or organize my thoughts on this. Before the COVID crisis, and I argued this in my study that I mentioned earlier with Horn and Trebisch, China's overseas lending had gone through sort of a classic euphoria phase where you do some overlending and you're bound to sort of live to regret it, having overlent. Not unlike, and for reasons not unlike what we saw with commercial bank lending in the United States in the 1970s. China was lending a lot to developing countries that were benefiting from a big commodity boom. And that commodity boom was in turn importantly driven by China's growth rate. That kind of favorable loop where China's growing double digits, commodity prices are booming, this makes a lot of developing countries that are primary commodity producers, which is mostly sub-Saharan Africa, good parts of Latin America and so on, but China's big Belt and Road Initiative is Central Asia and importantly sub-Saharan Africa. I think some of that lending boom will be scaled back. Meaning that I think in terms of the Belt and Road Initiative, there are areas where I think there's a sense that, okay, now a lot of these countries are having debt problems, repayment problems, commodity prices are down, so they're not as attractive as they were some years ago. So there's less lending there. However, I think China will reorient itself to lending in higher income countries. We've seen this in Southern Europe already. We've seen it in Greece. We've seen it in Italy. So the face of the Belt and Road Initiative, I think, will change. And the COVID crisis, I think China will also, after the COVID crisis, it will strengthen inroads into other areas where it had not been as active before. And specifically, I'm talking about perhaps in broad terms, a repositioning from their emphasis on low-income commodity producers in the past, decade and a half to higher income, more manufacturing producers and countries in the future. It is speculative, but it seems to be moving in that direction.
Dr. Reinhardt, for those of us who are trying to make sense of the global economy and trying to understand what metrics we should be following to see how healthy the economy actually is and if it's on a path to recovery or continuing to decline, what metrics should we be watching? And you mentioned a little bit on the financial sector and looking at non-performing loans and things like that. But if you look at the stock market, it's a very different story. If you look at unemployment numbers, it's a very different story. So what are the indicators that we should be focusing on to understand where we are in this crisis and when we might get out of it?
So I don't think I'm neither unique nor the first one by any means to comment on this issue, but the disconnect between indicators on quote unquote the real side of the economy and financial markets is striking. And I don't think financial markets or pricing in financial markets is where I would look first to see what is really happening. Financial markets, I think, have been very willing to look through what is the biggest output collapses that we have seen recorded, not just in the United States, but almost anywhere. And a big part of that is the expectation that US rates will remain low forever and that liquidity will remain very ample, and furthermore that almost anything has a guarantee. The new facilities by the Federal Reserve are buying, high yield, more speculative grade fixed income debt. The Main Street facilities are buying riskier parts of the bank's portfolios. The municipal, sub-sovereign, if you will, facility is buying municipal and state debts and so on. We have had literally, and this can be used accurately, unprecedented stimulus also via the form of these new facilities that offer a great deal of support to these high-risk markets. So bottom line of that is what you're seeing is a those guarantees are also importantly priced in, and the expectation of low for long is also priced in. So concretely, I think what we're seeing in much of the financial markets is, very driven by this, a reach for yield, a search for yield, rather than the fact that fundamentals are good. In terms of what I would watch is, and I said this in my commentary to Larry, that, having looked at a lot of crises, financial crises, currency crises, debt crises along my life, each one has its own flavor, but they do follow a certain, sequence, a certain pattern. But this one is being held hostage by the path of the disease. So every time that, you see a big flare-up, I think the issue of, the renewal of more closures, the renewal of more measures to limit, to increase social distancing, all the kinds of things that also can hit economic activity are rekindled. And so on the real side of the economy, I think we have to closely watch the progression of the disease to see what can be expected in terms of normalization. I mean, take something like, tourism and travel, which is not a trivial, chunk of income for many, many countries, and certainly business travel is. When is that likely to be normalized? Well, it'll be normalized when the disease allows it to be normalized. So I think, I would certainly not look to financial market pricing to tell me how healthy the underlying economy is. I really would look at the trajectory of the disease more closely.
And on that note, China has recently posted Q2 growth this year of just over 3% relative to last year. Do you think the Chinese economy has turned the corner, or is this a one-quarter result?
So look, turned the corner, I think it has, yes. But going back to what I said, they were the first to have the manifestations of the new pandemic, and they have been the first to, in terms of the timing, bring it under control. So this is, the economic indicators have indeed followed the path of the disease. Now, I think there is the question of rebound, and I have emphasized again, you can't confuse rebound with recovery. We're likely to see major rebounds everywhere simply because the output collapses of the worst quarters were, I don't know, 6 standard deviations away from the mean, or not far from that. Yeah, I mean, about in the case of the US, about 6 standard deviations away from the mean in terms of output collapses. But, rebound doesn't mean recovery. And by recovery, I mean that you have recouped your on a per capita basis, on a person by person basis, you're at least as well off as you were at the outset of the crisis. That is, at a minimum, you have the same per capita income you had before the crisis. That'll take a longer time. And in the case of China, I think one has to remember 2 things. I think rebound is well underway. I think it is supported by the fact that they've been able to contain the pandemic so far. China has also, in the last 20 some years, its growth rate has importantly been driven by two important sources. One was exports, growth of exports, and the other one is a growth of credit, domestic credit. So, you know, you had in the first part, in the export side, for an export-oriented economy, albeit one that has a very large internal market, but elements of that internal market are still underdeveloped. For a large export-oriented economy, returning to its pre-crisis, now I'm not talking level of income, but growth, 6%, seems unlikely in a world in which, you know, the rest of the world is growing more slowly and exports are growing more slowly, much more slowly, and supply chains are being redirected. So there's the export side, which is a damper. The other issue is debt, and I mentioned credit growth. And in the case of China, I'm talking particularly corporate debt. There is, you know, during the boom years, during the years in which Chinese growth was averaging more than 10%, which was the case between 2003 and 2013, growth in credit was a big, you know, driver of corporate expansion. So corporate expansion was very supported by big credit buildup, big corporate debt buildup, and that's where we are. So you have a very highly leveraged corporate sector in the period of slowing growth, slowing sales. And so bottom line is, I don't think the settling point for growth in China is going to be, you know, the pre-crisis 6%. How much lower will that be? I don't know, but I would expect it to be well below that 6%.
Great. We're almost at time. So maybe one last question that's a bit forward-looking along the lines of what Larry asked you too. You're on public service leave from the Kennedy School, and we look forward to welcoming you back in a couple of years here after you've done this important work at the World Bank. How do you think you will change your syllabus when you're back here teaching at the Kennedy School, in terms of what will we have learned about policy tools in crisis times that is different from what we know already and that you teach already?
So it's, I believe, a hard question for me to answer at this time, because I think we're still in the relatively early stages. I think the menu of tools will be a much longer list, a much richer list. We're doing things both on the fiscal side, on the monetary policy side, on debt initiative sides. Many of these things have not been done, certainly not been done in peacetime. And so I think, you know, the course that I teach on financial crisis would be much richer for having had also, you know, as I said, this did not start out as a banking crisis. It did not start out as a debt crisis or a currency crisis. It started out as a health crisis, and one of global dimensions at that. So that in and of itself, you know, it'll enrich that syllabus by looking at very real side origins of crises that, you know, I had focused a lot on the finance side, but I think this is forcing me to also look very closely at real side you know, health systems, environmental issues, things that can, you know, trigger a crisis that are outside the realm of finance. But also at the end of this, and we are not at the end of this, the list of policy options of what has been tried will be that much longer.
Thank you so much, Dr. Reinhardt. I think we're out of time for today, but it was a very insightful conversation. I hope we can invite you back to talk more as this crisis progresses. And my thanks to Nick Burns and to Larry Summers as well for their support of this economic diplomacy initiative, where we really do believe that multilateralism is the answer to a lot of the problems that we see in the world today. And obviously the World Bank is in the thick of that on the economic side. So thank you for everything that you're doing there and for your public service. And we look forward to talking to you more in the future.
And I want to thank you very much for having me, and thank Nick and Larry.
Thank you. And thank you all for joining.
Bye-bye.